There's a major shift occurring that will absolutely change how our economy works, how money flows, and stands to be potentially life-changing investment opportunity. I truly say that without any hype or hyperbole. And if you've been around here for a while, then you know I don't do doom and gloom, and I definitely don't sensationalize things. After doing all this research, I am very close to 100% certain that we're on the cusp of a commodity bull market, which could also be a super cycle, where gold could reach $6,000. Dang it, I keep saying that I hate making predictions, but what the heck? Everyone else and their mom has done a video predicting outrageous gold and silver prices, so why can't I? I mean, at least I'm not doing mine for clicks while pulling a number out of a dark, stinky, tight little hole in the lower half of my body. Some of y'all will get that reference later. You know, they say that predictions often tell you more about the person than they do the prediction. If that's the case, then I probably should start by explaining how I came to this conclusion. Ultimately, it's part technical analysis, part macroeconomics, part fundamentals, part ratios, and part human psychology and behavior. It doesn't matter what sector you invest in, you always have to keep your eyes on the big picture. As I say, when in doubt, zoom out. Widening your view helps you separate the signal from the noise, and this allows you to ignore the details and the daily gyrations in order to see the overall trends and big picture. While the focus on our channel is precious metals, our ability to understand the macroeconomy as well as the drivers of gold and silver prices makes a tremendous difference short term, but especially long term. What I found and my general conclusion is that we are on the cusp of a seismic change in how our economy and financial markets function. On top of that, there are lots of little shifts that are only amplifying this change, and it really comes down to one chart. But before I show you this chart, we have to set the stage a little here. And I need to apologize in advance because I have lots of charts and graphs to show you, so I won't be staying on them very long, so be prepared to pause and take screenshots. For the last 40 years, we have been in what Rick Rule refers to as a very benign economic environment as rates continue to fall, which resulted in consistent overinflation of financial equities. Take a look at this chart of the 10-year treasury rate and how it has continued falling since 1980. This resulted in ever cheaper money that flowed into the economy and financial equities in particular. You can also see here when you look at the S&P and bond ratio that the last time it was this high was at the dot-com bubble. And the other two times it was this close to this high was the 1987 crash and the 2008 GFC. This next slide compares returns between the S&P and bonds, and notice how close the returns were until 2015, and that is where we started to see the divergence. This is so very important because all this increased liquidity has resulted in a number of boom and bust cycles, be it money flowing in the dot-com companies to create that bubble, the 2008 real estate bubble that led to GFC, and whatever we'll officially call the 2020 event. Now, this chart of S&P 500 earnings really highlights how despite the booms and busts, stocks have continued only to go up and to the right. We have to remember that while the Fed can control liquidity through interest rates, and no matter how much money they helicopter all over the place, they simply cannot control where that money flows. Consequently, every time they have quote unquote rescued the economy with cheaper and cheaper money, all we did as a collective was push those cheap dollars into more and more financial asset. This is because as we were over financializing things and creating bubble assets here in the US, we were also undergoing globalization, which was deflationary and made goods less expensive. This is why for years we struggled to get inflation up to 2%, not down, but up to 2%. What does this look like and how can I prove what I just said? Well, of course, I have a chart for this. If you don't get anything else from this video or my channel, I implore you to pay attention to this moment and this chart because the shift is going to create financially life-changing opportunities if you, 1, understand the shift, 2, take time to learn and prepare yourself, 3, have the courage and conviction to take action, and 4, be firm in your investment thesis. This chart right here is the key to our economy for the next 15 to 25 years. The key is to understanding this chart is understanding ratios and reversions to mean, or as my mom used to say, things can only go wrong for so long and then they have to change. Ratios can have wild swings, but they always come back to average. This chart shows how the ratio of real assets to financial assets has gone from 1 in 1925 all the way down to 0.05 today. Now look what has happened since 1980. Remember all those charts I showed you and how bond prices have fallen over the last 40 years and how the S&P has performed? You can see how that ratio has continued downward to where we are today. Again, if you don't get anything else, I want you to understand this because it provides the context for where we are and why are we maybe on the cusp of a super cycle in commodities, especially for gold and silver. Stay with me because I want to layer in inflation and interest rates. If we look back at the 70s, the last time we had inflation like this, it came in 3 waves as this chart shows. It also did this in the 1930s. That means we absolutely should be expecting another 2 waves of inflation, which are already starting to happen because you look at oil prices are increasing and they're projected to go as high as $150. Oil is the mother of all assets, and it almost literally is involved in making everything. So higher oil prices means higher prices for everything, not just gas. Now that we have significantly higher interest rates that will be here for longer, we should expect money to flow into bonds as people flee stocks and shift away from risk assets. Well, this shift from risk assets tends to lower the price of a dollar of corporate earnings. Take a look at this chart, which shows for the first time the 6-month treasury bill is yielding higher than the S&P 500 earnings. Now, let's add one last significant variable. I'm kind of grouping these together: de-globalization and de-dollarization. Over the last 40 years, we lived and benefited from the deflationary impact of globalization. So as we watch the world divide into factions, and as we de-globalize and the rest of the world de-dollarizes, we should absolutely expect this to be inflationary. This also speaks to why central banks have increased and continue to increase their gold holdings. These folks, they know. They just haven't told us. And when they tell us, it'll be too late to take advantage of this financially, and getting our hands on real assets like an ounce of gold is going to feel impossible. If all of this wasn't enough to get your attention, we now have a war in the Middle East, which is likely to result in more money printing. Biden has already asked for $1 trillion in aid to Israel and Ukraine. In addition to that, we have oil-producing countries threatening to stop oil deliveries, as well as concerns that Iran might block the Straits of Hormuz, which would prevent delivery of oil. Come to think about it, $150 oil may be an underestimate. Okay, so if you're keeping score at home, that has to feel like I just ran up the score on you. But this isn't about doom and gloom. This is about recognizing where we came from, where we are, and where we are most likely headed. These are major shifts that are occurring, but because it's being done the same way you boil a frog alive, meaning very slowly, it can be very hard to notice the slight shifts, the slight increases in temperature until it's too late. Here's where the rubber meets the road. Take a look at another variation of this real assets to financial assets ratio and notice what has happened every time there was a crisis. It resulted in the ratio dropping further. But how much more can we compress this ratio? How much longer can we continue to kick this can down the road before things have to change? Because eventually that can becomes a keg of beer. Just look at this chart, which shows how asset prices have performed compared to real economy prices. Here's another chart of commodities versus S&P. Now look at the Huey, which represents gold stocks versus oil. Again, I ask you, how much more extreme can these ratios become? It doesn't look like it has much further downside to me. By now, you should be asking yourself, how should I prepare myself and where should I be putting my money in order to take advantage of what seems like a very asymmetrical bet, maybe even the bet of a lifetime. Finally, let's look at a chart of the economic cycle to get a better sense of where we are and what assets perform the best based on where we are in the cycle. First, I think we're in a high inflationary environment, and despite the rosy and highly manipulated data, we are definitely not in a recovery phase of the economy. This means we are either in the top right quadrant or the lower right quadrant. Personally, I think we're in the top right. As I see it, there are a number of incredible opportunities for those that are willing to act, and that's beyond gold and silver, physical gold and silver. As Rick Rule says, you're either going to be a contrarian or a victim. And guess what? You and only you get to choose. What does that look like? Well, I think the answers are in another set of charts I have for you. But unfortunately, because of time, I have to make a part 2 of this, and you'll have to wait for that for Tuesday. I really hate doing this to you folks, but it's far too important for me to rush through in order to try to keep this video under 10 minutes. So, in the comments section, do you think we're on the verge of a dramatic shift in our economy? What quadrant do you think we are in? Reflation, recovery, overheat, or stagflation? Are you mad at me for making a part 2 of this video? Again, I apologize. Or you simply can put an A+ in the comments so everyone knows that you always stack smarter and never stop learning.